Good evening. My name is Peter Resnicek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, May 17th, 2020. As the markets are in somewhat of a neutral juncture right now, which I'll clearly show you when we go through the charts, I thought it would be an excellent opportunity to talk about market-generated information versus opinion. Unfortunately, a lot of traders and investors really just use opinion or sentiment to base their decisions on. They read reports, they watch television, but it's not really very scientific. So in this video, I'm going to break it down into three separate areas, being technical analysis, market profile, and market internals. And in each one of these subsections, I'm going to show you all of the market-generated information that is currently happening, with the hopes that at the end, you'll potentially see some things that maybe you weren't paying attention to, and of course, increase your objectivity as well. All right, without further ado, let's get into it. So let's begin the first section of the video. As I said, I'm going to break this up into three separate parts, and the first part being technical analysis. So we're going to look at four separate things here. We're going to look at candlestick patterns, we are going to look at channels, we're going to look at moving averages, and we're going to look at Fibonacci. All right, so let's start with the first thing, which is candlestick patterns. For this, I'm going to start with the weekly charts, because obviously a week just ended. So we're just going to take a quick look at the S&P, NASDAQ, and Russell, which are the three majors that we always look at, and just kind of give us an idea of what did last week look like in relation to the prior week. So obviously the candle is kind of messy. You can see that the weekly bar has somewhat of a shadow on the downside. Ordinarily, that might seem bullish, but not in this case. Remember, the shadow is only bullish when it's at the end of a move, when you can see what's known as a buying tail. It's sort of this excess at the end of a move. When it happens inside of a larger range, it really just tells you that the market is looking for more information and things are just a little bit messy right now. So from the candlestick chart of the weekly, we really can't glean much information at all on the SPX. Moving over to the NDX, obviously, much different picture. Instead of that balance area that looks more like this, you can see that the NDX is powered much higher, but at the same time, the week in question, which is the week that just ended, completely ended in a stalemate. As a matter of fact, notice that the open and close of the candlestick of the weekly bar is pretty much equal. That tells you that bulls and bears had equal pressure over the course of the week and nothing really happened. Last but not least, the Russell, small caps, they were showing a lot of relative weakness early in the week, and then they showed a lot of relative strength on Friday, which was kind of tricky. Notice that the balance area is much larger, correct? And the shadow goes underneath the trend line. We'll talk about a little bit more on that in a bit. And notice that you have these candles lining up in terms of the bodies here. So whatever action from the open to close of the prior week that was bullish, the open to close of the last week was actually bearish, and they kind of line up. So again, this is all pointing to what I've been saying, that you have a little bit of a messy situation on your hand as far as technical analysis is concerned. All right, let's move on to the second section. We're going to talk about channels now. So I'm going to leave the same charts up, and we're going to switch over to a daily. And in this case, we are going to just take the downtrend here. We're starting with the S&P, and I'm going to redraw his channel and just move it to the low of this week, which gives us this channel. So looking at the S&P, we could make the argument that the market is now in a minor downtrend. I say minor because it's very mild, obviously, but it is obviously in a downtrend, in that this channel is obviously pointing from upper left to lower right. We could stay in the channel for a while, we could break out of it to the downside, or we could break out of it to the upside. All right, moving to the NDX. As I was saying earlier, different situation, because the channel in this case is an up channel, which is completely different from the other two indices. Everything's out of sync. Tech has been hot recently and continues to be so. Obviously a little bit weak on Friday on that China news, but redrawing the channel here in the NDX shows you what? A channel that is clearly moving from lower left to upper right. So obviously it's more of an up channel in direct contrast to what's going on in the S&P. And last but not least, let's look at that rut. Switching our chart back. And in the rut, again, we just take that, redraw, move it down, and the rut channel looks a lot more like the S&P, but a little bit steeper, correct? Notice that the rate of change, if you will, in the movement here is a lot steeper than in the SPX. The SPX is more gradual. This is because the Russell was relatively weak recently, and again, up until Friday, and was basically leading the charge to the downside early on. Notice also that it has broken its uptrend right here as well. Okay, let's move on now to moving averages. Now in this case for moving averages, what I like to do is keep it very, very simple. I'm a big believer that all you need to use are simple moving averages. You do not need exponential, and you certainly do not need to switch your charts over to logarithmic scale. Just keep the regular chart settings and keep your moving averages on simple. You do not need exponential, okay? When I deal with the simple moving averages, I have always only used 3 key MAs. Only 2 of the 3 are really most important, but I like to have all 3. Those 3 are always 20, 50, and 200. I say that only 2 are important really because you won't really get much of a trading signal from the 200. Trading signals generally come from 20s and 50s. And when you look at my charts, understand that the 20s are always green, the 50s are always red, and the 200s are always blue. So looking at the SPX on the daily and leaving the MAs up, I see the moving averages as market-generated information because it really gives me a quick, kind of 30,000-foot view as to whether or not the market is bullish or bearish, depending on which side of the MA we're trading on. So notice that here, when the market's in a gentle uptrend, the majority of the activity is above the 20. And anytime you move below the 20, traders buy it up. Here you get a little bit of consolidation below the 20, and again, traders buy it up. As soon as the break occurs here, notice that all of the activity remains underneath the 20. And then once again, when the trend changes again, what happens here? We break the 20, we have a little bit of difficulty resolving. So we move down, we consolidate again, and then again, all the activity above the 20. And now we break again, and we have activity below the 20. So again, this is really just extremely objective information. It's simple, but it works. You have to just understand that in the markets, oftentimes the simplest concepts are the ones that will make you money. You have to just stay with that. And it's also a way to keep you objective. For instance, if the market is clearly trending and it's well above the 20 and all the 20s are getting bought up, you cannot make the argument that there's anything shortable, right? Even though your opinion or sentiment or something you saw on television might say that. There's absolutely no reason to be thinking at all that there's anything bearish if you're always, riding above the 20. The red, by the way, is the 50, and notice that we are clearly above the red still in the SPX, which is a somewhat longer-term bullish sign, I would say, as more institutional money likes to read off of the 50 than they would off the 20, because the 20 is a little bit too fast for them. All right, moving over to the NDX. Again, same thing. Just looking at those moving averages, we found support here at the end and the 20. Obviously, the NDX is the strongest of the 3. No big surprise that it's clearly above the 20 and holding. And the Russell being the weakest, and this is where things I think get interesting. Notice that even with the 2-day rally, Thursday and Friday, really like a 1-day reversal, on Thursday, Friday rally, notice that prices are still underneath the 20, and it still wasn't even able, I should say, to break that key moving average or get ourselves up over the bottom side of the channel. So again, I'm still looking at the Russell as relatively weak. All right, last but not least, we're going to look at some fibs. And again, I'm going to switch my chart back to SPX with the Fibonacci's. It's very, very important also to keep it simple. Do not get over your skis or out into the weeds on fibs. This can get as deep or as shallow as you want it. Similar to the moving averages with the fibs, I'm really only interested in 50s and 61/8. I know there's 38.2s, I know there's other, you can do fib extensions, whatever. There's all different ways to look at this. The key numbers that you really want to look at for reversals are always going to be 50s and 61/8. 61/8 is the golden ratio. It's the most important Fibonacci number in the sequence. That is where I see a lot of go, no-go levels in terms of turning or changing a market or a stock from bullish to bearish. If you take out that 61/8, 50s are just as important, I think, because it's almost like a self-fulfilling prophecy that the average person, without even knowing that they're doing it, likes to get things at half off. Stocks move from 50 to 100, they get bought back at 75. It's just how it works because people, 50% off sale, people just like that, all right? So in this case, we're going to, again, keep it very simple. I'm going to show you where the fibs are right now in terms of the recent bounce from the lows, and we're only going to look at 50s and 61/8. So that being said, SPX, again, I'll switch my little tool to the fib, and I'm going to start here from the top of the most recent move, and we're going to take it down right to here. And again, market-generated information cannot be fooled with, cannot be messed with. M.G.I, you can't, make it up. It either is or it isn't. So, has the market bounced more than halfway? Barely. Has the market taken out the 61.8 on this bounce? No. Obviously, this is in the context of a channel here, so maybe it means a little bit less. Obviously, when you're looking at fibs on big clean moves, it means a little bit more. But again, given that the market is at this juncture where I'm not really sure what the move is next week, I'm just trying to get as much information as I can. Remember, you want to be a hoarder of information in this game. All right, so fibs on the SPX made it up to 50, barely, not the 61.8. NDX, same thing. We just take the tool from the top. How much was the bounce? More than 50, but stopped just shy of the 61.8. No big surprise, because obviously that NDX the strongest of the three. And the Russell, same thing. I'm going to start it from here, not from here, because I only want to know what happened with this particular sell-off. Obviously, fibs can be drawn from anywhere, and look where it stopped, dead on the 50, right at Friday's close, right at the 50. So again, all of these that we're looking at are just one data point. Think of that. That's very, very important. We've only now just finished the first portion of our three parts in this video. And within this first part, I've already showed you a multitude of different things. Each one of those things is only one data point, and you have to remember that. It's very, very important. What I mean by one data point is do not put too much weight on any one data point. That's also a mistake that a lot of people make. They'll just look at one thing. Maybe it's the fibs, maybe it's the channel, whatever. They focus on that one data point, and then that one data point drives all of their decision making. That's not how it works. You want to keep an ongoing narrative of what's going on in the market and bring all the data points together and just sort of weight them accordingly, more or less just kind of equally, and the more data points, the better. As I was saying earlier, I'll say it again, you want to hoard information. My mentor in the market profile, James Dalton, very famously said many, many times, the game is about organizing information. You need to organize information better than the next person. That's very, very true. Remember that, all right? So let's move into part two of our analysis, which will be market internals. Some of you may be asking, what are market internals? Market internals are just basically measurements, if you will, of different things that are happening under the hood that the average person doesn't see. They are measurements of breadth, and breadth can be defined a number of different ways. Sometimes when you hear breadth on the television, they're really talking about the advanced decline line. At ShadowTrader, we talk about breadth in terms of the relationship between volume that's flowing into up stocks and volume that's flowing into down stocks. The advanced decline line, which I just mentioned, we look at that too. I'll be talking about that. We talk about ticks on the NYSE and NASDAQ, and also the cumulative tick, which is a measurement of the tick just from that day, starting at zero and bringing it all the way into the close, right? It's a cumulative measure of the ticks, positive or negative. All of these are the internals of the market. And why are they important is because the market internals really, if you think about it, they are the ultimate form of market-generated information because they're literally coming from the market, right? I mean, everything that I've just shown you is market-generated information, but the market internals are coming strictly from the exchanges. When I talk about the internals, they're coming either from the New York Stock Exchange or from the NASDAQ. So it's a very broad read because it's picking up the activity of all of those stocks as opposed to an index, which is just a certain number of stocks, like 500 in the S&P or 300 in the Dow, all right? So in this portion of the video, what we're going to look at is we're going to look at the shift in market internals over the course of the week, where the early action in the week was very bearish. The action in the later portion of the week was bullish, and I want to show you how those market internals moved and shifted. And you'll start to see when I show you this on the chart that they weren't really all that bullish on the bounce, but they were pretty bearish on the move down. So again, just one piece of market-generated information, but we want to bring that into our narrative as we move along. All right, so this screen here that I'm showing you, this is what we call the quad. This is the bread and butter of the ShadowTrader methodology. I started teaching this about 13 years ago in the ShadowTrader Squawk Box. Brad Agunis has since taken over and is teaching it as well. And this is really what we look at all day long. You always want to have at least one screen dedicated to market internals where you have in this formation breadth, advanced decline line, ticks, and in your bottom right have a chart of whatever you're most trading be it ES or NQ, or I should say what market you're most trading. If you're more of a tech stock trader, maybe you want the NQ there. If you're more of a listed stock trader, big caps, whatever, maybe you want the ES there. I also would tell people that if you have the real estate and you have enough screens, don't just settle for a quad that looks like this where you have only NYSE internals. You don't see it here or in these videos. But what I'm looking at during the day is a larger quad on a different platform where I have New York Stock Exchange on the left stacked up, breadth, advanced decline line, and ticks, and I have NASDAQ on the right stacked up, breadth, advanced decline line, and ticks. And the beauty of this is so that I can A/B them and look at them in real time, side by side, and what that does is it immediately clues me into relative strength, relative weakness patterns long before most people see them. I see differences, nuances in the NYSE tick and in the advanced decline line that happen pretty quickly, for instance, on the NASDAQ side that are not happening on the NYSE side, and immediately you know, aha, something's up, you know, there's some strength over here. This can help you immensely as the day unfolds because, for instance, let's say you were about to get into something really bearish on the ES. Okay, maybe trading ES or what, it doesn't matter, something in the S&P. And at the same time, everything in the ES is stacking up and looking like the planets are aligned, like you're going to get that bearish trade-off and it's going to work. But at the same time, maybe NYSE ticks, for instance, are failing to go below zero. They're just holding, and all the pullbacks in the NYSE tick are just going to, you know, plus 100, 0, plus 200, and you're not getting any negative action in the ticks. That push-pull dichotomy is going to work against your short in the ES. You have to understand that. In order, you know, most trades, especially those of the shortest term variety, need all planets to be lined up. And when I say all planets, I mean both of the major you know, markets, being the NYSE and the NASDAQ. They have to be working in concert, okay? So all that being said, if we look at our quad here, let's start with the breadth. Let's blow up this breadth chart right here. And this is a histogram form here on the bottom, and these are just candlesticks showing. And what this is this is the relationship between volume flowing into up stocks on the NYSE and volume flowing into down stocks. And let's just look, if we could, for a second, at just these last few days here of just this week, which is obviously Monday to Friday. Look at how the breadth was acting here on Monday, on Tuesday, and on Wednesday, which was a trending day down, right? Look at this here. And here in the corner, you only see the current day. So this is the relationship between up volume and down volume on the NYSE and on the NASDAQ on Friday. And notice the numbers. And this is this. So this was the big rally, quote unquote, of off the lows on Thursday and Friday. And yet, 1.21 to 1 positive and 1.52. Folks, this is so lackluster. Like a strong bullish day will have reads of 2 to 1 positive, 3 to 1 positive, on up to 5, 6, 7 to 1 positive. When the market was selling off here in this manner, we started at double-digit breadth to the downside. You were looking at 9, 10, 11, whatever, to the downside, and it stayed pretty negative throughout the course of the day, where you had a solid read of, say, you know, 5 or 7 to 1 negative, meaning that the amount of volume flowing into stocks that were down was 5 or 6 times the amount of volume flowing into stocks that were up. That's what was happening on those down days. But in direct contrast, notice that here on these up days, look at the difference between just looking at it graphically in the candles and looking at the histogram of all of this. We can make like a demarcation line here between this activity, and all of this. So the point I'm trying to make is when you're reading this M.G.I, you can clearly see that the bearishness was more bearish and the bullishness didn't seem like it was all that bullish. Now, granted, this can change on a dime. I don't know really, to be honest with you, what next week will bring. But again, these are single data points that you want to bring into your analysis. All right, let's move over to let's crack it back to the quad here. Let's move over to the advanced decline line. And same thing, I'm just going to maximize it. Now, on the advanced decline line, there's a couple of things you want to remember. I'm just going to circle that 2,000 level right there. Minus 2,000 or plus 2,000 is very, very important in the AD, very noteworthy. I'll give you a trick, kind of a tip you can use right now. When the AD is pegged, meaning that it's just gone sideways, and I think I've talked about this in prior videos. You can see I'm just drawing like a sideways line right there. When the AD is at 2,000 or worse or better on the upside, let's say it's on the upside, every pullback is buyable that day. If the AD is sub 2,000 on the downside, every bounce is technically shortable on that day. Usually you will get a trending day either to the upside or the downside when you have this situation. So that being said, again, looking at just the 5 days, notice what happened here. Sell off down to here to 1750, and then this day all the way to 2,500, and then here before the market turned around, look at all these ticks. Between straddling Wednesday and Thursday, minus 2,500. So that's, a decent amount of selling to be that low, right? And then look what happened when we rallied. Advancers, decliners on Thursday made it to where? Barely broke zero only at the end of the day. Friday opened negative and then did what all day? Advancers and decliners just kind of undulated here, hit a top at 500 and came into 354. All right, so that's the M.G.I. of the advanced decline line. All right. Last but not least, let's look at ticks. And for ticks, I have to look at cumulative tick because obviously the tick itself is not going to tell you very much. All right. Because ticks are basically just going to act like drunken monkey. They're going to go all over the place. So you want to have some sort of a cumulative tick indicator to help you along so that you can see more of a all-day total of what's going on. All right. By the way, hint, hint, this is available at ShadowTrader.net. I don't like to sell you stuff in the middle of a video, but honestly, this is some of the best money you'll ever spend. This cumulative tick indicator is only 95 bucks. People swear by it. It's a one-time charge. You don't have to have a subscription or whatever. It'll work forever. I send you the code, you put it in your charts, and you can thank me later because honestly, it is a very, very important piece of information to have as the day unfolds to how that cumulative tick is either building from lower left to upper right, staying flat, building from upper left to lower right. It tells you a lot of important information at a glance. That being said, if we look at the cumulative tick activity over the course of the week, what is it showing us? Again, very similar to what I was showing you in the breadth and the AD. Cumulative tick down heavy here, down heavy here. The absolute number at the end does matter. In the cumulative tick, minus 6,000 or 7,000, that's a pretty bearish read. And again, when we get into Thursday and Friday, we barely crack 1,800 here, and we spend the majority of the time undulating on either side of, back and forth on the zero line, all right? So switching back to the quad, all right? So to wrap up this section of market internals, again, I must stress to you guys, everything just one data point. And obviously, we're in kind of a strange time here. Anything can happen next week. Buyers and sellers often have delayed reactions to things. I don't know. But our job is only to go on information that we have in our hand at the moment. And the information that we have in our hand at the moment shows us that from a technical standpoint that we've already looked at, it's kind of neutral. From an internal standpoint, the bounces that occurred on Thursday and Friday were very weak. And last but not least, we're going to look at market profile, a subject that is often very, very important to not forget, near and dear to my heart always. I do think that everybody should learn this form of analysis because I think it is so important. Again, just one data point, and in this particular example of market profile, I have to be very careful to only talk about just a few different nuances because remember, we could easily get into the weeds for hours on market profile, dissecting every single nuance. But you have to be very careful in looking at market profile. Again, don't overdo it. Keep your eye on what's important. There are always one or two very important events that happen in every single daily distribution, and then the rest, there's all sorts of nuanced events. So for instance, either you have a poor high or you don't. You close on a poor high, for instance. That is important. Maybe you have some anomalies in the distribution. That's maybe not as important, right? Maybe you've got a very, very small section of single prints in the middle of the distribution that's only, say, 3 points high. Probably not that important, but if you've got a section of single prints splitting that distribution into two parts and those single prints are 17 points wide, very important. Now you know you have to treat that distribution as two separate days, very important, okay? So in this part of the video, I'm just gonna deal with a couple important factors, all right? Starting with, we're gonna go backwards here for a second and look at the sessions here from approximately May 8th in here to the 12th, and I hope I have my dates right. And I'm going to just draw a horizontal line like this. Look at this 28.95 level. So you've got basically a 3-day balance right? And within that 3-day balance, you have a high here. This was a poor high, by the way. Notice the lack of excess. And you have an overnight high that double tops at that high. And you have RTH highs. This one's poor as well. This one has a little bit of excess, which cleans up this one, right? It's been repaired. But you have RTH highs here that are clearly lower. And those RTH highs then have the same support for 5 different sessions. When I say 5 sessions, it's because I'm counting the overnight sessions as well. So you have them here. So there are RTH sessions and overnight sessions. And then you have a very large break at the end of a day. This break is known as a spike. And spikes create what are called spike rules. Spike rules essentially say that because the activity that happened in the spike was so late in the day, it is not possible to validate whether or not the prices that the spike created are fair or not, right? Because think about it, because the spike happens at the end of the day, the market then closes on leaving the spike in its wake. We don't know if the market is going to retrace all that very quickly, gap back up above it, or accept those lower prices of the spike by basically trading within the spike or trading lower than the spike. So knowing that, notice that what happened after the spike was created, all of the activity later in the week, which would be Wednesday, Thursday, Friday, is below the spike. So what does that do? That validates the low prices here of this break, and that is short-term bearish. And when the market tries to rally on Wednesday, Thursday, Friday, notice that on Wednesday, right, it opens here in the spike. You have a little bit of acceptance in the spike, but not very high, and we sell off. Thursday doesn't barely make it into the spike. If we say that this is the spike low, only at the end of the day, when it closed bullish, does it make it a little bit into the spike. And Friday was also kind of a bullish move off the lows, equal close, which is interesting. I find that noteworthy. That's another piece of market-generated information you want to carry forward. For all the bluster that happened on Friday, the close on the futures was actually dead equal. Again, another poor high here, which needs repair. That's what causes the market to sell off a little bit into the close. You have the poor high. And again, does it get into the spike? No. And this whole thing with the spike and then the late day, the later week action in the spike is very important because it falls under that guideline, if you will. I can't think of the right word right now, but that theory or whatever of the when what should happen doesn't, right? I call this WWSHD. Right? Rubber bracelets coming soon, by the way. When what should happen doesn't is very, very important because when what should happen doesn't, the market is generally going the other way. And also, whenever when what should happen doesn't occurs, you want to make a note of that in your narrative. It's very, very important. Those WWSHD moments are often the most important ones to carry forward in your narrative. So in this particular instance, to me, what should have happened late in the week, in the Wednesday, Thursday, Friday, is that opening in the spike or going up a little bit into the spike, to me, should have brought in more short covering, right? Think about it. What resistance would there be in the spike? Very, very little. Spikes are often, or should be thought of, I should say, similar to gaps, meaning there's no resistance there because it was very emotional selling creating the spike. Spikes are created by market orders. Spikes are not created by traders who are thinking long-term, who are investing for the future, or even putting on larger short positions that they want to build in the hopes that the market's going to be lower 2 weeks from now, 2 months from now, etc. It's not how it works. Spikes are created by panic. They're created by simply stops being broken, and traders just hitting the button mercilessly and saying, get me out of this position now. So knowing that, how would you think prices should react when they move back up into the spike? Really by hitting a lot of those same traders, buying those stocks back or whatever. And I just thought it was noteworthy this particular week with the bullish action later in the week that we weren't able to travel very high into the spike and we actually found very little acceptance into the spike. Could we find that acceptance next week going forward? Certainly we can. As I was saying, not pounding the table here for either direction. This is really just an exercise in objectivity and showing you the different types of market-generated information that the market is giving us. All right? Continuing on with the profile, I'm also just going to point out, again, remember, keep it very simple. The less data points, the better in terms of the profile. Value is pretty much unchanged, especially on Wednesday and Thursday. Value was completely unchanged, and value was pretty much the same on Friday. And then not that important, usually more important on a trending day, but you want to kind of keep an eye on where the POCs are. So you see these green spots, it's probably very faint on the chart, but those are highlighted in green. The spots highlighted in green tell us where the greatest amount of volume in that particular session traded. On a trending day down, you want that to migrate down as it did here. I would be thinking it was more bullish if, for instance, on this day when we broke that support and we liquidated, or here where we broke the support, but then we followed through with a liquidation further the next day, I would think it was less bearish if, for instance, the POC was up here, but it's not. The POC was actually lower. In this particular session, we closed on the high. This was also very, very important to me. This is classic M.G.I. right here. Notice that the POC closed on the settlement, which is relatively rare, but it happens. It also closed in the upper part of the range. Ordinarily, if you just look at that, you might be thinking, oh, but Peter, you trended to the upside, you closed the point of control at the highs, should be bullish. But the most important thing to pay attention to in this particular day is the fact that only these two areas of the POC registered more than 10,000 contracts. That is very, very noteworthy. I talk about something called the taper all the time. When you're looking at stocks or futures, really, I say you can use market profile on stocks, but let's say you're trading ES or NQ. You're coming down to where you believe there's an inflection point at low or high. The volume will always taper. Taper all the way down to the point where you probably get like 37 contracts at the low. You'll have the bulk of the distribution where every level trades more than 10,000 contracts, and as you come down to a lower high, you will taper down to say 9,000, 8,000, 6,000, 4,000, 2, then 300, whatever, 200, and the bottom tick will generally be some very small number that is under 100, okay? So keep that in mind. This generally only happens at the extremes of moves. But on this particular day, and remember, it was an up day in the markets. I'm going to make this bigger. We're looking here at this column here, okay? Look at the entire day. So I'll just highlight this. Do you see any 10,000 levels? No. The only ones are, like I said, the ones at the close, and they don't count because there is always a huge flurry of volume in the futures markets between 4 p.m. and 4:15 p.m., usually very, very close to that 4:15 close, and the price levels at the settlement always have huge volume. In this case, they only had 11,803 contracts and 13,466 contracts, which is almost nothing. Understand that on a regular day, you've got big volume all over the place, and most of the sessions or most of the price levels are well over 10,000. You only see the smaller levels when you're looking at just the taper areas, right? Just the extremes of it. So this day, as I was saying, all day as the market is moving up, it's all tiny volume. So that's interesting. Again, just one data point, but I carry it forward. Right? I think it's definitely noteworthy to carry that forward. That in a day that was generally an up day where you had this upside reversal, you weren't able to commit any contracts to the upside. What does that tell you? In hindsight, really that the buying was more short covering in nature and emotional. Remember, the larger players will not act this way. The larger players will be looking to buy on the bid, and they make the profile generally fatter, more looking like this, where there's better distribution at different price levels, and it's a little bit wider. So I just like to keep that in mind as well. All right. So profile-wise, I would say that's it. I was looking at that volume, and then I was also looking at the value not moving. I'm a huge believer in that value has to shift. So if the market is going to be bullish next week, you definitely do not want to see these yellow boxes being overlapping as they are now. You're going to want to see them breaking away. Maybe they can overlap a little bit, but remember, the stronger market is the one that has the value completely broken away and not overlapping in any way, shape, or form. And those are the three sections that I wanted to talk to you about, where you've gone through now technical analysis, market internals, and market profile. And I hope that you come away from looking at those, obviously, as I was saying in the intro, with more objectivity and more data points that you can look at yourself in your own trading. But to make a decision now as to what's going on, it clearly shows that things are relatively cloudy. From what I showed you, it basically is telling us that the advance on Thursday, Friday was weak compared to the selling of earlier in the week. That's our market internals portion. In our market profile portion, we discerned that market generated information was telling us that there was a liquidation break late day earlier in the week, and technically it should have been bought back up, but it wasn't, and yet value established clearly lower. That's kind of noteworthy. And then we had that up day there in the middle that had very little volume distribution at each section. So that's also very, very important, right? And then we also talked about technical analysis, right? We talked about chart patterns, and we looked at a number of things in TA that really are pointing more to a neutral bias right now. We started with the weekly charts. They were very, very messy. Some big tails, some big consolidation, not a lot going on. We looked at channels. What did the channels tell us? NDX channel up, S&P gradually down very gently, Russell still pretty down, right? We looked at moving averages, some below, some above, and again, we looked at fib retracements as well, showing how much have we actually bounced from those low to highs, and it's kind of a mixed bag there as well, but for now, everything as of yet has not yet bounced higher than that 61.8, all right? So again, all of the things I'm talking about, and we've covered a lot in this video. Remember, each one is just one data point. One data point by itself doesn't mean very much, but many data points all put together can give you a much clearer picture of what's really going on. And that's all for this week. Thank you, as always, for spending just a little bit of your weekend with me. So to recap and encapsulate, if you will, everything we just discussed, not really pounding the table here for any particular direction. There are a lot of mixed signals out there. Next week is definitely going to be very, very interesting. But I implore you, as you go through each day and you navigate, potentially you might start to pay more attention to some of the things that I talked about in this video to help you along the way. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.